Hi there, good morning. This is the booster course for chapter 12, right, on accruals and prepayments. Again, they're just boosters, they're just quick kind of summaries of the key theories. You still have to watch the main long video, but again, just to kind of give you a flavor of what it's really about. Okay, right, what are we saying? So, I kind of came from this telling you that accounts had to be four things, right? Relevant, reliable, comparable, and understandable, right? And the reason we have this, if you like, is because we need to be able to trust a set of financial statements. These four things kind of make accounts kind of what we say, we declare them to be true and fair, and people can respect them. Now, it means if we're going to be able to compare A and B, we must have certain guidelines and standards that we all work with. So, I gave the example of having I think two characters in class, A and B, and imagine one was using a cash system and one was using sort of a credit system, and one was paying some things for some of the period and not for not of the period. You'll just have you'll have these different profits, and we just won't be able to compare A and B. And so when you watch the main video, you'll sort of see me go through that whole kind of theory as to why we have these kind of concepts. So the accruals concept sort of says we must record everything for the period and only for the period, number one. But we must also match all expenses that relate to income generated for that period. So if you generate income for 12 months, we want to see the related expenses for that 12-month period. Nothing more, nothing less, if you like. And in fact, even income, if you've received any income, we want to see income for 12 months. Not about you've received only income for 6 months in a 12-month period. No problem. That's all you've received. We want to actually see what income you should have received. Same thing for expenses. You want to see the expenses that should be there for the 12 period. So let's go straight away and see what I'm talking about. So here's a situation. You have an electric bill. So you have your year is 1st of January to 31st of December, right? Let's take electricity. Let's talk about expenses first. So you have electricity that you have incurred for the whole year. Your expenses for the year are actually 12,000. That's the bill, 12,000. But so far you have only paid 5,000 through the cash book. So when I say you've paid 5,000 through the cash book, you've written out a check for £5,000. You put it in the cash book. The cash book is your subsidiary book. It feeds through to the general ledger. Remember, the general ledger has your T accounts, electricity, and bank. So what do we have? 12,000. Sorry, you've only paid 5,000, 5,000, and 5,000. So what am I saying? I'm saying that if at the end of the year you still haven't paid, or you still haven't paid the balance on this electricity that should be 12,000 for the year, what you have to do is you need to show 12,000 for the year in the end. So because we need to transfer to the income statement. When you watch the long video, you see me go on about this quite a while. Transfer to the income statement, £12,000. So if you need to transfer to the income statement £12,000, it means you need to recognize another 7. You have used electricity worth this additional 7, and we call this an accrual of expense. It is a liability, right? And so now I can transfer to the income statement 12,000. Income statement, this is my income statement account. It's an account. I said this many times. That's electricity, 12,000. Now I can close these off. 12, and that's gone. So my income statement now has electricity, and I also have the 7,000, of course, in here. So that's the 7 here and the 7 here. Let's just look at the accounting equation and see how this relates. A is equal to C plus L. So you have and you have E, of course. You buy some electricity worth 5,000, so E goes up and A goes down, right? That's what's happened here with this 5,000. That's the 5, that's the 5. You use some more E, but you haven't paid. So more E goes up and you have L. That's what we're recognizing. So we can clearly see that it's important to show everything through the income statement. Right, then I'm going to carry on with this example here, just to sort of finish this through. So what I'm saying is that your syllabus teaches, that now this is a liability. It's brought down. So we have carried down 7,000, brought down 1,000. So your syllabus teaches, well, that at the beginning of the next year, you have this accruals of liabilities that you owe of 7,000. You owe this. So it's saying for the next year, for the next period, so let's just have electricity, your first task is to transfer this figure from here, so to electricity, 7,000. You can call this, I don't know, reversal of accruals, 7,000. So we can clearly see when we're about to begin we owe this 7,000. We owe this 7,000. So if your electricity was actually 12,000 every single year, you're not just going to pay 12,000. You need to pay 12,000 plus 7,000, right, out of the bank, because you need to pay what you owe for the previous period. Use a different color just to kind of show what's really going on here. So it doesn't matter whether you break it up like this. You say, okay, I'll pay 7,000 first out of the bank to clear what I owe from last year, and I'll pay 12,000, which is for this year. In the end, 19,000 leaves the bank account. And you can see again, by doing this, all I'm transferring to the income statement again is my 12,000. Yes, that's my income statement, 12,000. Right? And you can see that. So that's kind of, I mean, I'm going to make these videos short. That's kind of how we deal with the recognition of an accrual in one period and then its transfer in the next period and how we address that, right? So this is the, I'm going to keep this video short. This is the accrual of expense, So you need to kind of get used to that. I'll mix it up a little in the final video, but this is the accrual of expense. Okay, great stuff. See you in the next video.